Good afternoon, everyone. I just have one rule for my presentations, which is you need to be awake when I start. After that, you're on your own. So, pleasure to be able to join you here in beautiful, sunny Orlando. Not really too much going on in the economy these days, so I'm not sure what we'll talk about for the next hour, but I'm sure we'll think of something. And whatever we talk about is more than likely to change by tomorrow, so take it all with a grain of salt. I'm going to cover three topics here today. The first is issues that we're seeing in the broader economy and how the economy is performing as we, as the first quarter of the year winds down. Secondly, condition of the construction industry and how that's shaping up. And then finally, what architecture firms and the broader real estate industry are telling us about the construction outlook for the remainder of the year and into 2026. So let's start with the major economic indicators that we track to look at the health of the economy. And for these, I've got this table, I've got the most recent release and compare that to where it was a year ago so we can sort of get a trajectory of where we're headed here. And let's start with inflation. Inflation's been sort of top of mind and top of the business pages for past couple years now. It's been moving down. It has stalled recently. The February number that we got just a week or so ago was encouraging. On the other hand, I think the recent tariff battles may put inflation back up again, and I think that's what the Federal Reserve is concerned about. Short-term interest rates were easing in response to the Fed's interest rate cuts, although the Fed seems to have suspended these cuts until it gets a somewhat better reading on inflation. And I just saw that this afternoon the Fed, in winding up its meeting, has held the short-term interest rates stable for the time being. Long-term interest rates, a bit more determined by inflation as well as economic growth. They haven't moved as much. Consumer sentiment had been stable, but it's been falling the last couple months, so that's not a good sign. Housing still suffering from affordability concerns. I'll talk more about that in a minute. We did get a starts number yesterday, a housing starts number yesterday, and that was up a bit, so that's at least somewhat encouraging. And then employment, probably the single most important indicator of the health of the economy. Recent numbers have been really recently healthy in that regard, and I've got a little bit of history there in terms of what the employment numbers are doing. And it continues to be a very key factor in the outlook for the economy. So, coming out of the pandemic, we saw job growth extremely strong. Numbers have been easing since then, as you can see with the trend line I have on this graph. But generally, when we see growth in the 200,000 or so a month, that indicates a healthy economy. The recent numbers have typically been in that range. On the other hand, we will see what the numbers look like once the federal layoffs get to be incorporated in the monthly job reports. Long-term interest rates, talked about that. They began easing last fall as the Fed began easing short-term rates. However, unlike short-term rates, long-term rates don't move one-to-one with the Fed's actions. So I have a line on this graph that indicates the Fed's half-point decline in interest rates mid-September last year when it began this most recent easing cycle. As you can see, the 30-year fixed-rate mortgage began falling well before the Fed actually cut rates in anticipation of those rate cuts. But since then, as you can see, mortgage rates have been really fairly volatile, moving up when inflation looks to be heating up, easing a little bit recently when it looks like the economy might be softening a little bit. Overall, though, there's been more talk of an impending economic slowdown, and we're starting to hear the word recession a bit more often in the news of the economic reports. And in fact, there are a growing list of threats to the economic outlook. And let me run through some of the key ones there. Number one, tariffs, their likely impact on inflation, growing uncertainty among consumers and businesses, and that's reflected through the lower consumer confidence scores that we're seeing recently, as well as the increased stock market volatility. Layoffs of federal employees, as I mentioned, lower federal spending, which long-term probably will help. Short-term it's going to slow economic growth. And then immigration policy and the potential for increased labor shortages in industry like construction. I'm going to talk a little bit about that in a minute too. So let me move on to quickly a little diversion into the housing sector. Housing, important indicator of where the construction industry is headed, but it's also a key indicator of the direction of the broader economy. Housing generates an awful lot of economic growth. So home building's been weak. Housing affordability has become a critical national issue. We saw housing and housing affordability mentioned in the most recent presidential campaign, and we hardly ever see housing on the national stage because there's just not an awful lot that the federal government can do about that. So a lot of concern is facing the housing market, and it results from the rapid increase in house prices that we've seen in recent years that are showing here. So house prices have increased 75% since their last peak, heading into the Great Recession, and 50% from where they were as we headed into the pandemic. So really an unprecedented rise in prices. So high house prices coupled with high mortgage rates, rising insurance costs have exacerbated the housing affordability crisis for households looking to buy a home. And I've got a little Texas humor on this topic of high house prices. So where do we stand in terms of longer-term housing needs? Are we producing as many homes as we need to accommodate our growing population? So put it in perspective, we averaged about 1.5 million housing starts a year in the 1980s, fell to about 1.4 million housing starts a year in the 1990s, and then jumped to over 1.5 million a year in the decade leading up to the Great Recession. Last decade, we didn't even average 1 million housing starts a year, so production levels were off pretty considerably. And so far this decade, we've gotten closer to traditional production levels, but we haven't really made a dent in the backlog of our housing needs. So the sense is that we have a fairly significant deficit in the number of homes that we have built in recent years, which is the main reason that house prices have been rising so rapidly. And while there is a consensus that we do have a housing shortage that's causing inflated house prices, there's much less of a consensus as to how large that shortage here, so how large that shortage is. So I've got here 9 estimates as to the magnitude of the housing shortfall. As you can see, considerable variation in these estimates. And the differences between how these organizations have estimated our housing shortage have a lot to do with the different methodologies that they've used in calculating this, and as well as different definitions as to what a housing shortage really is. So the high estimates generally are measuring the shortage of affordable housing. They include households who are paying an excessive share of their income on housing and call that a housing shortfall. The middle estimates are basically estimating missing households. They look at, as I just did on my charts, how many homes were produced annually historically, how many are produced now, and estimate the number that didn't form, the number of households that didn't form because housing costs were too high and therefore couldn't afford to get into the market. And then the lower estimates look at vacancy rates. They compare current vacancy rates with historical vacancy rates and estimate how many more homes would we need to get back to historical levels. If historically the rental market runs at a 6 or 7% vacancy rate and it's down to 2% now, for example, then they estimate, well, this is how many new homes, new apartments we would need to get back to these more traditional levels that we see. Moving on back to some broader issues that the construction industry is facing. These are results from a recent survey of construction contractors by a publication called Equipment World magazine, and they asked respondents what potential changes in policy would have the greatest impact on their businesses. This survey was done in December, so when we had a new administration in place. Now, some of these changes are thought to have a positive impact. Those are the green bars. Others are thought to have a negative impact. Those are the red bars. So number one on their list was a rollback in environmental regulations, most frequently selected impactful policy, followed by lower interest rates. That looks less likely in the near term than maybe it did a couple months ago. And tariffs and stricter immigration policies were common concerns as likely negative policy initiatives for the industry. So let me dig in a little bit into two of the major initiatives of the Trump administration, tariffs and immigration policy. For tariffs, many have been threatened, including the imposition of tariffs on our three largest trading partners, Mexico, Canada, and China. These tariffs, as they're implemented, if they are in fact implemented, would have two major impacts. Number one is they're going to raise prices on imported goods, and the construction industry, as you all are well aware, relies on many imported goods for their, from these three countries. I've given just a few examples in this slide. Secondly, countries on which are imposed tariffs no doubt would retaliate and have already threatened or actually begun to retaliate with tariffs on U.S. products, which would hurt U.S. producers. And this is a very tricky situation to try to sort out the impact of tariffs on the construction industry, on the economy. So tariffs have been a moving target so far, on again, off again, likely are going to continue to be, and that's causing certainly a lot of confusion and uncertainty from the folks that I talk with. What countries are going to be subject to the tariffs in the final analysis, what products are going to be subject to tariffs, what's the impact going to be near term and long term, all very difficult questions to deal with. So one way to think about this is assessing exposure to potential tariffs. What products do we care about for our own individual line of business? To what extent do we rely on imports for these products? And of these imports, what share are coming from countries that are being targeted? In the current instance, that's Canada, Mexico, and China principally, but in the future could change. So a few examples for key construction outputs here. Just kind of walking through wood products, obviously high on the list of concerns. 78% of wood products consumed in the U.S. are produced domestically, 22% imported. Of those 22% imports, 60% come from Mexico, Canada, or China, 40% from other countries. No surprise there that Canada really dominates in terms of this product, and other ones too. And like I say, I've just picked a few examples here, and I think as this becomes a larger concern, probably worth going through this exercise for all or most of the major products that you care about in terms of where do we get them from and what's the exposure we have as these products are tariffed, and where do they come from? Do they come from a country that's likely to be tariffed or not as likely to be tariffed? So we've already seen some of the impacts of the proposed tariff increases on the price of construction materials. These are producer prices for construction inputs, and they've been relatively stable for the last couple of years. They were a big issue early in the pandemic. Then we largely forgot about them for the last 2 years because they've been stable. But the threat of, merely the threat of imposing tariffs had caused some volatility in materials, targeted for tariffs. So these are numbers just released a week ago for the month of February, producer prices for the month of February. They show a 0.5% increase overall for construction inputs, the big basket of inputs to construction. Since month-to-month changes tend not to be that great, I also put in an annualized rate. If this rate of increase would continue for a year, what level inflation in producer prices would we see. So for overall, 0.5% translates to, do the simple math, 6% over the course of the year. Increase overall in the month of February was higher for goods than it was for services being architectural inputs, engineering inputs, things like that. And the increases were higher for lumber, steel, copper, brass, aluminum, materials in general where tariffs have been either imposed or or threatened to be imposed. Second topic here I wanted to talk about is immigration and the impact on the construction labor force. So to give you some sort of baseline figures, construction industry has about 12 million workers nationally. About a quarter of those workers in the construction industry are foreign-born, and this share rises to about a third if you're just looking at the construction trades. And higher in particular for some of the trades, and I'll run through that list in just a minute. About half of the foreign-born construction workers in the country today are undocumented, so an average of about 1 in 8 construction workers overall undocumented, 1 in 6 of the construction trades undocumented, again higher for some trades and in some areas of the country. So, I think it's fair to say that all of the construction trades reliant on immigrant labor to fill positions, but some of the trades are more reliant on foreign-born workers than others. What I've got here is a list of some of the trades that have a higher immigrant share, and that includes plasters and stucco masons, drywall and ceiling tile installers, roofers, painters, and paper hangers. These are the ones that are just sort of above average for the trades. So for some trades, more exposure. For some areas of the country, more exposure too. 4 states plus the District of Columbia, those 4 states being California, Texas, New Jersey, and Maryland. In those 5 areas, immigrants account for over half of the construction labor force, so clearly a bit more exposed there, number one. 5 other states, New York, North Carolina, Georgia, Florida, Nevada, foreign-born construction workers account for at least 40% of the construction workforce. So, yeah, huge exposure in general to immigrant labor, but as I say, even greater in some areas of the country and in some of the specialty trades. So in general, I think it's fair to say that construction is facing some very serious economic challenges moving forward. So the bars on this chart represent the share for the construction industry. The dots represent the share for the overall labor force, for the metrics I'm looking at here. We've already discussed the importance of immigrant labor to the labor force, but also construction has been really uniquely unsuccessful in attracting women into the trades. And women account for about half of the U.S. labor force, and you can see here low single digits for the construction trades. And then moving over to the right-hand side, construction historically has relied on young men to fuel the labor force, but the construction labor force is aging. The share of workers age 55 and over has, as you can see here, doubled over the last 15 years. Increase for the labor force in general. We're getting older as a labor force, but been particularly hard for construction. And one other point here before I move on to the next topic, kind of a little side note here, but with the flurry of executive orders that were signed in the early days of the Trump administration, one that largely has flown under the radar was one dealing with the design of federal buildings, saying that these buildings should reflect traditional and classical architectural heritage. Well, that's a directive that you might guess didn't sit too well with the American Institute of Architects, who's working to allow really more diversity in design and a reflection of local influences. So as I said, stay tuned for that. I think we at the AIA haven't quite given up on this battle yet, but we'll see. So let's move on to the next topic, which is trends that we're seeing in the construction sector. And let me begin again with a big table of numbers that'll gloss your eyes over here. But let me walk through some of these. These are construction spending numbers that we get from the federal government every month, the Commerce Department, and it talks about spending in particular categories I've identified here, the major non-residential building categories. And comparing the spending levels in 2024, these are year-end 2024 numbers on this chart, relative to year-end 2023 numbers to see how the markets performed over the year. So the takeaway here is, I think, construction was pretty healthy last year. Spending on non-residential buildings was up almost 6.5%. A little less on the commercial side, a little more on the institutional side. A couple of trends to point out here, though. Number one is, 6.5%, a reasonably healthy number in terms of growth in spending. We track these monthly, these numbers monthly, and these have been declining. We're declining every month as we move through 2024, starting out the year in the high teens in terms of growth, ending up the year in sort of the mid-single digits. That's number one. Number two, probably more significantly, considerable variation in the performance across several sectors, particularly on the commercial industrial side. So you look at the manufacturing numbers there, up, 20% over the year, and earlier in the year they were up 60 or 70%, so very strong growth in terms of manufacturing construction. Number two, on the sort of commercial and other retail, traditionally think of brick and mortar retail construction there. Actually, half of that number, almost half of that number, is warehousing. So really driven by a very different phenomenon than traditional brick and mortar. Number three, the office market. Not a big number, 2%, but office is being the weakest sector in the commercial sector. Why are we seeing any growth there at all? And the reason is, in their infinite wisdom, the government has included data centers in the office market, and they've been, as you well know, moving in very different directions. So those are the pieces. Let me just add one little update here. This is the same table with the numbers for January 2025 compared to January 2024. So just 1 month of numbers comparing to what it was a year ago. But wanted to kind of just demonstrate where these trends are headed. And so 6.5% growth for 2024 as a year. As you can see, that's dipped down to just over 3.5% when we do January over January. And a similar trend within the categories, a little weaker on the commercial side, a little stronger on the institutional side. We've seen those manufacturing numbers kind of return to earth, reasonably healthy numbers, but not anything like we've been seeing from that sector over the last few years. And let me just kind of walk through that because it really has been so phenomenal, in terms of the growth of manufacturing activity. A lot of that, fueled by federal legislation, the Inflation Reduction Act, the CHIPS and Science Act, even somewhat by the infrastructure funding. But as you can see, that spending on the construction of manufacturing facilities was sort of plodding along through most of the last decade. Suddenly accelerated as the pandemic hit. Spending on manufacturing facilities tripled between 2020 and 2024, and increased more than 50% in both 2022 and 2023. So really off the charts in terms of the level of spending there. But manufacturing was really not the only outlier that we saw in spending during this period. We have three that really were driving growth. One, manufacturing I've talked about here. Secondly, warehouses. That's, you can see, tapered off recently, but early in the pandemic we just saw a ton of warehouse construction. That sector apparently was overbuilt, and we're seeing it slow a little bit now. And then, finally, we're getting the federal government to break out data centers as a separate construction category, which really is pretty unique. And that's not a big share, but it's a share that's been growing pretty dramatically. And I think anyone you talk to that tracks this market kind of agrees that it's going to continue to grow at a pretty pretty dramatic pace. Now, what's the significance here? You know, so 3 markets were growing. 3 markets account for 35 to 40% of all spending in the non-residential building category. Certainly from a perspective of architects, these are not core markets. These are really kind of niche markets in terms of activity. You know, when I go out and talk to architects, I'll ask them, you know, what share of your work comes from manufacturing warehouses or data centers? You know, is it anywhere near 35 or 40% of your portfolio? The answer is almost none. And so I think part of, you know, assessing the performance of the construction industry in recent years really depends on, you know, are you exposed to these 3 markets or not? Are you doing work in these 3 markets? If you are, you probably had, you know, pretty good years in terms of levels of activity. If you're not, it's been a bit more challenging in terms of workloads that you're seeing. So let me move on to another concept. The last charts that I talked about were construction spending, how much is allocated to ongoing activity on a construction project. I'm going to move over to construction starts now, where kind of the entire value of the project is logged at the time of the start. These are numbers again for 2024. So if you remember back to the big table for 2024 on spending, you can see the pretty marked contrast we're seeing between ongoing spending levels and new projects that are being started. So spending up 6.5%, starts down 8.5% in 2024. Commercial and institutional sectors, not too bad. We saw some growth in starts last year. Big change was the decline in manufacturing construction. So that surge that we saw from that chart, 22, 23, 24, growing 50% per year or not, looks like we're getting back to more traditional levels of manufacturing activity. A 50% decline is dramatic. On the other hand, 50% off of what we were talking about before still leaves it at a pretty healthy sector of the economy. Let me give you a little more detail there starting with the commercial industrial side. Core sectors were generally pretty weak in terms of starts. Spending on offices, again, with that asterisk on it because data center is driving all the growth there. Traditional office continues to be weak. Retail facilities and warehouses are each down at a double-digit pace. Some of the, this is not all of the categories within that, but some of the smaller ones, like amusement facilities, as you can see here on the chart, sports facilities, convention centers were up at a pretty healthy pace. So some of those smaller sectors were doing pretty well last year. And then on the institutional side, again, starts numbers for 2024, a lot less variation in the major institutional sectors. Good news if you're working in those sectors. Education is the largest institutional category. Starts are up, as you can see. Starts were up across the board. Bit weaker for colleges and universities than they were for secondary and high schools. Medical facilities are growing, as is spending on government offices. We'll see what happens there once we see a right sizing of the workforce and this return to office mandate as to what the demand is there. But we'll track that trend. A firm called Construct Connect track building information. They've been very kind in sharing some of their data with us, and particularly concerning projects that have been facing difficulties. Their so-called Project Stress Index. If you haven't seen that, you should follow that. Provides useful information. So this index bumped up a bit as the pandemic hit. Then stabilized, shot up again in early 2024. We saw another blip in the fourth quarter of last year. So what their index shows is the magnitude of the number of projects facing difficulties. Base year for this was 2021. That was a period of relative stability. That's why we see so much fluctuation in 2020 and in 2023 to 2022 to present, because we've seen a lot more volatility than we saw in 2021. So that's the general line. Their project stress index is a composite of 3 components. One is projects that are delayed, Second, projects that are indefinitely on hold. Third, projects that are abandoned. So let me walk through those three elements to this. The first one here is projects that are delayed, as you can see, didn't move around an awful lot over the period since they started collecting this information, fairly consistent there. On hold projects, really high as the pandemic hit, probably not a surprise there. They've stabilized quite recently. But then canceled projects, the most serious category, were the principal cause of the spike early last year that I talked about. Sort of projects that are on hold caused the spike during the pandemic. Projects that were canceled caused the spike last year. Seemed to have a lot to do with, the industry at that point, early 2024, was expecting lower interest rates, lower long-term rates with the Fed easing. That didn't materialize, and so a lot of projects just didn't make financial sense, and instead were scrubbed. Another little blip more recently in terms of project cancellations. Again, I think an interest rate problem that earlier this year we saw those long-term rates spike up a little bit, and I think that's what's causing the blip there. One of the growing challenges to the construction industry is the increase in the number as well as the increased severity of natural disasters. So while the severity of these natural disasters is quite variable, jumps around a lot depending on what happened that year, again, I've got a trend line in there that shows it's been steadily moving up over the last few decades. So 30 years ago, damage from natural disasters averaged about $25 billion a year. That's an inflation-adjusted number, so that's comparable to what we're seeing now, about $25 billion a year 30 years ago. That number now is averaging about $125 billion a year, so a five-fold increase in real damage caused by natural disasters. Last year started out quite tame, but Hurricanes Helene and Milton pushed losses up to almost $200 billion. This year, as you are well aware, got off to a terrible start. Estimates from the California wildfires, in the first 2 weeks of this year, in one single metro area, we created about what we see in the year nationally in terms of losses from natural disasters. One last point here before I get into the wrap-up, the outlook, which is, another sector that's generating an awful lot of growth in our industry is work on existing buildings, renovations, retrofits, additions, and so forth. So as you can see, we've been tracking this for the last 20 years or so through the vantage point of revenue at architecture firms. What share of your revenue on a dollar basis comes from work on existing buildings? And heading into the Great Recession, that was about a third, so a pretty big number. Once the recession hit, construction activity slowed down dramatically, slowed down more rapidly than reconstruction activity, so that rose to about the mid-40s, as you can see there. Not a surprise. What was a surprise is as the industry began to recover as we moved through last decade, that share didn't taper off at all. It stayed in sort of the mid-40s range. And towards the end of last decade, kind of early years of the pandemic, started to get pretty close to 50%. Our best sense is this number is going to stay in the 50% range for a while. A lot of older buildings out there that need modernization. Economy is growing more slowly. Population's growing more slowly. We don't have as much need for new facilities, so we'll see more attention and more energy spent on existing buildings than building new ones. So last topic here is the outlook. A little bit on what architecture firms are telling us about their sense of the outlook, and a little sense about what the real estate industry is telling us. Let me begin with what architecture firms are seeing with the Architecture Billings Index. And let me start with a show of hands. How many of you are generally aware of what the Architecture Billings Index is? Okay, quite a few hands. How many of you should be more aware of what the Architecture Billings Index is? There you go. There you go, and we'll deal with that right now. So let me quickly talk about what this is. It's it measures the level of business at architecture firms. It's a panel of architecture firms, about 750 that participate in this out of the 20,000 or so architecture firms across the country. But it's naturally representative of those 20,000 architecture firms in terms of the size of those firms, the location of those firms, and the specialization of those firms. It's been collected for about 30 years, so we have a pretty good sense as to how this performs as we move through construction cycles. And number 4, I think the most important point here is that we've done a couple major statistical exercises on this. And it turns out it's a very accurate at predicting construction activity. Not a surprise there. You need to design it before you build it. But the lead is just as critical. It leads construction activity by 9 to 12 months. So it gives you a pretty good sense of where the industry is headed with almost a year lead on that. And then the final point is just interpreting it. It's an index that's centered around 50. Any score that we report above 50 in our Architecture Billings Index indicates that revenue, billings activity at architecture firms is increasing. Any score below 50 indicates that it's declining. So let's run through some of the numbers. And they haven't been that great recently. Big dip as the pandemic hit, not a surprise there. Bounced back pretty quickly, took less than a year for architecture firms to report declines from the pandemic until they were reporting increases again. And some pretty healthy numbers back there in 2021 and 2022. Beginning in late 2022, some in the fourth quarter, the numbers from our Architecture Billings Index survey began to, I would say, more stabilize, weaken, kind of move sideways, and they did that for about a year, up through third quarter of 2023. And then it began to soften more significantly. So we're up to almost a year and a half of more sustained declines in billings activity at architecture firms. We haven't seen really much of a pattern in recent months, modest declines some months, somewhat more of a decline following months as the projects move ahead in fits and starts. Fourth quarter of last year, we started to see some positive signs, looked like we had hit bottom, started to generate some optimism. Then we got the December numbers, which were weak. We got the January numbers, which were weak. Got the February numbers. We released those this morning. They, again, were weak. 45.5 was the score for February. So still dealing with issues there in terms of workloads at architecture firms. So billings is our principal measure there, but we also track 2 other indicators of future design activity. One is we call new design contracts, and that measures the work coming into architecture firms. What's the volume of activity that's going to generate future billings? Those numbers have been just as weak as the billings index, so no signs yet, at least, that we're turning the corner here and workloads are starting to come in, which will increase billings in coming months. Third measure is inquiries. It's a somewhat softer measure of potential future design work. As you can see, they've been growing, but pretty slowly. The growth rate's kind of eased off a little bit. I think we like to think optimistically it indicates that there's work on the sidelines here, that they're just waiting to step in, but we haven't seen signs yet. And I will give you one insight from the numbers we released this morning is that the inquiries index actually dipped below 50 for the first time in a really long time. So still dealing with some issues here in terms of future workloads. We additionally we break the billings index down by specialization. So architecture firms are categorized as to whether a majority of their work comes from multifamily residential, commercial industrial, or institutional. If they don't get 50% of work in any of those 3 categories, we call them a mixed practice firm, and put them in a fourth category, which we generally don't report because it doesn't provide much insight. It does turn out that about 80% of architecture firms in our panel, and I think that's representative of national numbers, do concentrate in one of these three sectors, do get 50% of their billings in one of these three sectors. So how have they been doing? Turns out, as you can see, none of the three are doing very well. Multifamily residential is super strong in the early days of the pandemic, started falling off in 2023. I just got numbers here through 2024 in the first quarter of this year. And they have not rebounded yet. There is some optimism around the multifamily sector I'll talk about in a little bit later, but we're not seeing it yet in architectural billings. Commercial, industrial held up fairly well through 2023, but as you can see, the 2024 and first quarter 2025 numbers are really quite weak. Institutional, what's the expression? Best looking horse at the glue factory, something like that. Doing a little bit better, but still not showing any signs of really beginning to reverse. Architecture firm backlogs gives us a sense of how well they can sustain a downturn in activity, and backlogs have held up surprisingly well. Peaked, as you can see, at 7.2 months there in mid-2022, only dipped to 6.5 months now. We do this quarterly, so we'll get another reading in next month as how well they did in the first quarter of this year. But they have held up pretty well, all things considered. So the weak workloads have not been enough to really draw down a lot of the work that they're sitting on. Architecture firms, like I talked about the project stress index, architecture firms also are dealing with project delays, stalled projects, canceled projects, and that can take a toll on their backlogs too. And in fact, earlier this year, we did get sort of a look at the project stress index from the vantage point of architecture firms, and asked architecture firms to report the status of their portfolio. So the question was kind of projects that you've worked on over the last 6 months, on a dollar basis, how many of those are proceeding as normal? Or what share are in the delayed category, what share in the stalled category, what share in the canceled category. I would say the results for that were, all things considered, reasonably optimistic. Almost 3/4 of projects, architecture firms are saying no problems at all, moving ahead at the pace we expected. About half of the rest, the other 28%, half were stalled. Delayed, almost the next largest stalled. Only 4% fell into the canceled category, which means they're not coming back. So the potential for the rest of those is that if things pick up a little bit, they may pop back up and build up those inventories. What do architecture firms think about 2025? I've talked about kind of 2.5 years of weak conditions, year and a half of really concerning conditions. They expect a rebound in 2025, and the quick answer is not really. About a quarter of firms think that their revenue is going to be lower in 2025 than it was in 2024. About a third of firms feel it's going to be essentially the same, and about 40% of firms feel that their revenue is going to increase in 2025, although, as you can see, not by a lot. Very few firms are saying they're going to see a significant or expect to see a significant increase in revenue. So looks like basically kind of a little more of the same. No signs of breaking out of this pattern and some surge in construction activity. And I think what's happened nationally over the last few weeks and months certainly aren't providing any encouragement that we are going to see a spate of construction activity. Let me wind up with just a couple more points here. One is looking at the real estate market, and I think we found by tracking these that property values tend to be a pretty good indicator of where some of these commercial sectors are heading. Value of existing properties are declining, it typically is a disincentive to adding new space. Why would you build space in a market that's seeing a decline in values? You do see a bit more work on the reconstruction side. Let's fix up this older building rather than build a new one, but it does generally depress construction activity. So this is information from a firm called Real Capital Analytics. They track property values, and you know, I think the takeaway from their numbers, and I'll walk through you in just a minute, is that the downturn is beginning to stabilize really across all the commercial sectors, or virtually all the commercial sectors. So what I've got here is 1 month increase in values or decrease, 3 month, and 1 year. So, you know, apartment and particularly office values have seen modest declines over the past year. Retail sector seems to be seeing a bit of a recovery, but all the sectors other than retail, generally the 1 month and 3 month numbers are pretty flat, pretty much indicating no fundamental change in values. You know, as I say, seems to suggest that we may be hitting a bottom there. On the other hand, I think the 1 month, 3 month, and 1 year don't give you a full picture, so I've really gone back now with this a couple of decades to see sort of what trends are. This is the overall index, you can see, popped a little bit early in the recession, the pandemic recession, kind of came back and is now sort of flattening out at what I would say are pre-pandemic levels. But other sectors, kind of a different pattern. So if you look at apartments, for example, you know, you've seen a pretty dramatic decline in apartment values over the last couple of years, but off of a super high growth that we saw, you know, #1 throughout the last decade, given the shortages that we're seeing in housing I talked about. But early in the pandemic, you know, apartment property values really smoked, and so now we're just seeing a little give back from that. Next category is retail. You know, retail were the most optimistic numbers I showed on the 1 month, 3 month, and 1 year, but you know, they've been pretty flat for the last two decades or so. So hard to extend that too much. Industrial, no surprise, was really moving pretty aggressively until recently, as we saw sort of the industrial manufacturing numbers begin to flatten out a little bit. We're also seeing those values begin to flatten out a little bit. And then finally, the poor office market that has seen some relatively decent recent declines, not off of any growth. So we're seeing office values now that are below where they were 2 decades ago on average. So still a lot of mending to happen there before we see a rebound. What's the real estate industry, the real estate investment industry see in terms of 2025? Where do they see as the stronger or weaker sectors moving into this year? Well, these are results of a survey of real estate investors. And the question that was asked to these real estate investors was, this year, do you plan to increase your investments in this property type from 2024 levels, hold it steady, or decrease your investment? Increase to same, lower. And the numbers I've got here are the share that said increase minus the share that said decrease. So kind of net growth in investor interest in those sectors. Probably not too many surprises there. Data centers continue to be extremely hot. Healthcare, traditionally strong sector with the aging of the population. One surprise, or not a surprise, but at least I think a telling sign, is it looks like multifamily is finally coming back. There's some investor interest in that after a few years of decline. Offices, again, no surprise, very, very weak. Some softening in hospitality and retail, and industrial looking to be about flat. So I'm going to end up with our construction forecast for 2025 and 2026. These are numbers from the AIA, the American Institute of Architects Consensus Construction Forecast. We publish these twice a year. We go out to the leading construction forecasting firms in the country, ask for their top line numbers averaged them and called out the AIA consensus forecast. These numbers were released in mid-January, so 2 months old. As we talked about, nothing at all happening in the economy over the last 2 months, so we know that they're accurate as they stand, but we'll see what happens when we interview them again, our panel again in June and early July to see what's changing. So what are they telling us? As I said, started the presentation a reasonably positive 2024. They're projecting a slowdown this year and next, increase of just over 2% throughout the overall non-residential building market this year, not much better next year. Probably not even keeping pace with inflation in materials and labor costs. We don't inflation adjust these, so I'm guessing the volume is going to be down a little bit in terms of square footage. Commercial side expected to be weak this year before increasing just a little bit next year. Manufacturing, still a lot in the pipeline there, which is going to drive a little growth this year, but that slowdown that we saw in starts is going to start pulling down spending next year, according to this group. Institutional expected to perform kind of okay, but not great. And then a little bit of the detail here. This is on the commercial side. Let me explain what I've got here too. So a lot of categories. As I said, data centers in the government record keeping is encompassed by the broader office market. So I've got total office and then the data center component of that. As you can see from the numbers there, data centers $28 billion in spending last year, offices $100 billion. So they're telling us that 28% of office spending was on data centers last year. Same is true on the retail and other commercial and warehouses. Warehouses are a component of the retail and other commercial in the government data. The numbers there are, $60 billion on warehouses, $127 billion in the entire category. So almost half of retail and other commercial spending activity last year was for warehouses. So continue to be a big component. So what are the trends? Offices up a little because of data centers. If you net data centers out of offices, that's projected to be, by this group, projected to be down about 3.5%, 4% next year, this year, and another % or 2% next year. So still seeing declines. Retail, warehouses included in the retail and other commercial, but those numbers are essentially the same. So netting out warehouses doesn't really much affect the overall outlook. And then hotels that really saw a deep decline during the pandemic, finally starting to get back a little bit of growth there. And then finally, institutional buildings, and as I've said many times during this presentation, a lot more stability there. Healthcare and education are certainly two that we watch very closely. 60% of spending in the institutional market is in healthcare and education. Both of those doing pretty well. A little bit of consolidation recently in the healthcare market that's depressed spending on new construction, particularly the bigger regional facilities. The smaller sort of community healthcare centers seem to be going pretty well. Education market still seems to be benefiting. The demographics are not nearly as positive on the education side, but still some pent-up demand from underspending on new construction and reconstruction during the pandemic, so those numbers are going to remain fairly strong. And again, some of the smaller numbers, smaller categories that I didn't include here, religious, public safety expected to produce some smaller gains. So I finally got us to the end of this presentation, I think. I want to just take 1 minute to talk about what the takeaway is. If you took my advice and dozed off at the beginning, I'll give you the quick summary here on what we see happening in terms of the construction outlook. So number one is an unusual amount of uncertainty at present affecting both consumers and businesses, and unless and until these policies are clarified, the current economic expansion is at risk. I think, consumers nor businesses like uncertainty. They're very difficult to make decisions in an environment where you don't know what's going to happen next. And until there's some clarification, I think we're going to be seeing reduced levels of activity. Tariffs and immigration policy topped the list of uncertainties. Housing affordability, talked about that a little bit. Concerns have been building for over a decade. Don't see really any end in sight for the residential market. Much of the growth in spending in recent years on the non-residential building side has been driven by a few niche sectors. As I mentioned, if you're engaged in those three sectors, you probably are reporting pretty good numbers over the last few years. And if you weren't engaged in those sectors, life was a little more challenging. Architecture firms, which provide, as I mentioned, an accurate leading predictor for future construction levels, have been, really have seen some challenging conditions for over 2 years now, and we don't see any signs of breaking out of that trend anytime soon. And then finally, the commercial real estate market looks to be at or near bottom. Most of the major markets there still challenged, but I think I think we're starting to see maybe a bit of a glimpse of hitting bottom and moving back out again. Key institutional sectors like healthcare and education look to have more of an upside moving forward. I think most of the growth that we see in non-residential building this year is going to come from the institutional side. Hope to see some growth on the multifamily side. I think we're finally starting to see that turnaround, and eventually on the commercial side, but still some really big challenges we're dealing with there. So I think, Stephen, we still have a few minutes for questions, discussions. Any observations you might have about what we see happening for the construction market moving forward? Go ahead.
I believe over the past, since the pandemic, we've seen a lot of federal dollars entering the market. Can you talk about what that has caused and
Whether that will be continued or what impact it might have on future levels of activity? Yeah, I mean, certainly a lot of threats there in terms of, are we going to, already have cut off a lot of the research funds available to colleges and universities, for example. I think like a lot of other things, let's see how these policies are really implemented as to what impact they're going to have. But I think it's fair to assume it's not going to be anything good. That's why I said it sort of at the beginning when I was talking about the consensus forecast, how this market looked in early to mid-January when we released the last numbers are different than how they look now. And I'm very interested in how this group is going to read some of these recent trends into that and what they expect moving forward. The institutional market where those federal dollars flow, they really don't flow much into the commercial market at all. May see some softening. We'll see. I think it really depends on how much of that is kind of staff related as opposed to kind of capital expenditures, and how therefore it might impact construction or not. Other questions? Here? No? We do not break down our billings index by state. We don't have a rich enough database to break it down below the the 4 census regions. I think we just need a much larger sample to do that. You can sort of get some sense of that by how the regions are moving. I mean, I didn't present those numbers, but the Northeast region has been the weakest recently in terms of architecture billings. The Midwest did very well up until recently. I attribute that to being a disproportionate share of manufacturing activities located in the Midwest. If you look over the last 5 or 6 years, the South has performed the best. That's where population growth is, a lot of economic growth. And the West, a bit of a mixed bag. Generally it would be South the best, West the second best. That flipped a little bit as the, kind of the Midwest picked up a little bit with the manufacturing, but I think that's the trend we'll see moving forward. I think these folks are ready for a reception here, Stephen. I don't know. Okay, thank you very much.